I have with me in studio John Carlson. He's the president of Mark Taylor Investment Management. John is responsible for strategy, operations, new business development, and property portfolio performance for 19,000 plus luxury apartment units in Arizona and Nevada. The company, Mark Taylor, has been the single largest multifamily developer in the state. They've built more than 20,000 units. So we're excited to have John in the studio to spend time with you today. So, John, welcome in.
Thanks for having me, Patrick.
Yeah, good to be here.
Great to be here.
Yeah, and being in Scottsdale, this is your second appearance here. I know we had you in on the Innovation Summit. And
loved it.
Based on what we're talking about there with sort of like the all arrows going to Phoenix in terms of acquisitions, this being sort of a investment community around the people that fund some of those operations. I wanted to just sort of, for those of that haven't experienced a conversation with you or familiar with the Mark Taylor brand, this is national and even a global audience. So tell us a little bit about who you guys are, what you're working on, and we'll just start with that.
Yeah, founded in 1985 by Jeff, Mark, and Scott Taylor. Back then they were really just trying to carve out a niche that would allow them to feed their families, if you think about it in basic raw terms. Fast forward, 35 plus years later, 20,000 plus units constructed, 19,000 plus, as you mentioned, managed. Today we're about 82% third-party managed. So what you have to know about Jeff and Scott is a lot of their decision-making over the course of those 3 decades has been translated through data, the lens of data. A lot of it through Scott's background. He's a CPA by trade, moved here in 1982 from Seattle, worked with John Goodman Real Estate. Many of you have heard of that group, that outfit. John's really famous in the multifamily space. He really knew he had to, really from the ground up, understand the fundamentals of Phoenix, understand how the metro ticked from jobs to population to growth to what markets mattered from a multifamily perspective, what were desirable, where the best demographics were, et cetera. So he really started to create that data set going back to 82 and then forming Mark Taylor with Jeff in 1985. So a lot of their decision making has been through obviously instinct and experience over the years, but through the lens of data. So if you look at today, we're under construction on 2 deals in North Scottsdale, but our primary focus right now is really third-party management. So there's a gluttony of developers focused on Phoenix Metro for lots of reasons, which we'll get into. But I really think about why people want to be in Phoenix today, and we'll get into that. But it's truly a market that has matured. I'll say it that way. And I think back to the last cycle, 2008 and 9, I still have it's a miniature sign that I have on my desk, and it says 3 months free concession. And Tanner and the likes can remember those days. I mean, we're just trying to create market share and fill units from an occupancy perspective. Today we're at 0.2% in concessions, which is literally zero. It's like 1 day of concession. So the market's as hot as ever, and I've never seen anything like it in my 20 plus years in this business.
It's more diverse now than anything before, true, right?
Absolutely. I mean, if you look at the foundation, so before we get to product, we think about just the multifamily product type from 2008 prior. We were primarily a garden-style community, and that's okay, 15 units to an acre. But we really transitioned post-recession, and what I mean by that, the quality, the elevation of different product types, going from really a garden style to now we have mid-rise, we have high-rise. Average density of units being built after 2011 is about 40 units to an acre. So you really started to see the city go in versus out. We were forever the spread out market, vast city, vast metro. So you're seeing these infill locations, these great product types, finish levels, amenities. We talk about the arms race to amenities. You look at the fitness centers, the amenities, the common areas, they're tremendous. So if you compared multifamily product to single family home product in 2008, it was significantly different. Today, I'd argue that you can go to any multifamily deal that's been built 15 and beyond and argue the finish levels are comparable or better. with amenities in locations you want to be in from a lifestyle perspective.
Yeah, that's interesting. And as a third-party operator, you mentioned a strong majority of your focus now is on growing that part of the business. I would imagine having that data and sort of that development process in place makes that uniquely competitive.
Absolutely.
Or differentiates, I should say.
Yeah, I think we're unique in that we can look through the lens of both developer, owner, and manager. Some groups can't do that. And we've only focused on Phoenix Metro, so it's our backyard for almost 4 decades. So that gives us advantages. We can talk about the different cycles. I can speak specifically to, I lived it, 2006 and 7 when we stopped development on our last deal. We finished it and did not go to construction or build in the last 4 pieces of dirt we had. Mostly because of Jeff and Scott's instinct, but also data saying, something's happening here. We need to hit the brakes. And not everybody can do that because, as Tanners and others know, there's a cycle to that process, right? You're acquiring capital. You're starting the process of the development. You can't just hit the brakes,
sure.
Especially once dirt starts to move. And then subsequently after that, as we moved through the recession, Phoenix was blacklisted. I'll say it that way. Institutions did not want to be here. A lot of people were burned in the single family and multifamily space. You were going through receiverships. There was a lot of pain, 9, 10, 11, in the perception, which matters a lot. As we all know, the perception of Phoenix was there was a black cloud over Phoenix, stay away. Fly over to California, fly to Texas, stay away from Phoenix. But we convinced our lenders in 2011 to go to construction on 3 deals. So we were one of the first multifamily developers in 2011 to break ground on anything and built the majority of our assets this cycle, 11 through 18, by design. So, a tribute to both Jeff and Scott's instinct, but also our data set.
Sure. You mentioned those cloud days. A lot of people are not around. They couldn't make it through those periods. How did you as a leader move your organization through that period, obviously, where you guys are in a great position today? I mean, that's something that takes unique leadership skills, long-term focus.
I think mostly we were steadfast in the idea that Phoenix Metro would be better tomorrow. One of our principles today is be better than yesterday. And I think about us having conversations as a leadership team then, and we didn't have the 19,000 plus units to kind of fall back on. We were much smaller as an organization. And, we had to find ways to really focus on how could we be better and create a product, a management, a lifestyle that residents would want and seek. So we focused a lot on that aspect of the business at that time and truly just believed that the market would come back. And the benefit of having veterans like Jeff and Scott saying, no, we've gone through this before. We saw the savings and loan crisis. We were here in the late 80s. There's a lot of things that they've seen and done that helped us get through that. Experience matters. And when you're in the room saying, hey, I've seen this before.
Right.
This is what happened. This is what will happen. And, we don't have a crystal ball, but if you look back in our data sets, you can see a pretty specific trend with what happens coming out of a recession, and it happened.
Yeah. So tell me, why Phoenix? You mentioned a lot of people are looking at Phoenix. Tell me what the story is today.
So many strong things. So we think about Phoenix as having a large funnel over the Phoenix Metro of capital investment or cash. And it's spitting out chunks of money, and you just can't find enough deals. There's so much appetite and demand for Phoenix for many reasons. I think one piece, excuse me, you have to think back to why people are leaving the markets that they were in. So there's really a demand for Sunbelt states. You see a lot of chatter, a lot of conversation and action through, think about 1031 exchanges. So people leaving coastal cities or cities that, from a forecasting perspective, have less desirable job growth or demographic shifts. And Phoenix is one of the darlings for that reason. I think of the shift of Phoenix Metro in the state of Arizona going back to the recession. So I think our leaders, as it pertains to the state, not only legislatively, but from a really a education standpoint. You think about Michael Crow, I mentioned this last time. the resurgence of ASU. Being, I think, they've had 5 consecutive years of being the most innovative school in the country based on U.S. News. Their STEM advancement, right? In STEM, they're one of the top 3 schools in the country and have been for 3 or 4 years. So the advancement of education has really helped propel, I think, the workforce as an entirety to support more growth from a business perspective. You think about GPEC, the things that Chris Camacho and them have done for the state, making us I'll say, open for business state. We've become as competitive as Utah and Texas, siphoning in jobs from California in a very fast way. So you think about the big groups, TSMC, lands in northern Phoenix. That's a big deal. The largest manufacturer of semiconductor pieces for Apple, as an example. The momentum of that is tremendous. So all of these things have happened, keeping our taxes at a base that makes sense, keeping us competitive. Governor Ducey and the GOP getting done the budget that kind of offsets the Prop 208 issue that we had from a tax increase perspective, allows investment to continue to come here. So it's a lot about what we've done as leaders of the state, creating a pro-business growth mentality that also goes into the perception of other states and other investors. It takes time. So if you think about that from a data standpoint, look at the supply of multifamily and the single-family permits being issued from 2009 through 2016. Very small numbers. If you think about the size of Phoenix Metro, the population, almost 5 million today. We've been undersupplied as a market for 9 straight years, or since 2011. Factoring in national household growth formations, being undersupplied, you really have to go back to the 80s and think about birth rates. It matters. Birth rates were accelerating from 82 through 92. You're seeing the fruit of that today. You're seeing millennials expanding households, taking bigger homes, taking bigger units, expanding their household. That factors in. And, why did we crash in 2006? And I'll get into some data as to why this is not a bubble today. But in 2006, you had a demographic that had birth rates 30, 35 years ago going down. So think about the Supreme Court decision in 1973, I believe it was, to allow for abortion. You had declining birth rates. Well, that factors into what happens 30, 35 years later in terms of household formations. They were declining as we were increasing supply. Just one component of the housing bubble. It's the opposite today. We have supply going this way and household formations going this way.
Right. And not everybody's tracking that kind of data.
Correct.
But you guys are.
Yes, absolutely.
So tell me about your team there. I mean, we are at the Innovation Summit, we were talking a lot about even self-guided tours and the way that you're interacting and creating an experience, making it frictionless for customers to become residents, stay residents, and also some value for your efficiencies with your teams. Tell me about your technology stack and the data so others can understand. A lot of times you have to either license data or you're getting it in silos. Tell me about this.
Yeah, I mean, I think if you look at what happened through the pandemic, a crisis creates opportunity. So if you think about us, we had, and I mentioned this before, we had a model that was consistent with many years of success from just an overall operation perspective. So I'll give you one example. You'd have one person per 100 units on the admin side, one per 100 units on the service side. Many other things we just did because that's the way we were doing things for many years and everyone was doing it. Fast forward to pandemic, and April of last year, we lock our doors. We have a pandemic happening. We don't know what we know today, or we didn't know. We were very concerned. We were hedging against the unknown, but locked the doors in at least twice as many apartments as we normally would. So we had to sit back as an executive team, really as a multifamily group or leadership, and say, okay, what were we doing wrong? And or what can we do to make this better? Because it's clear that we can fundamentally make operations work with doors closed.
Right.
So what's that tell you? The invention, if you want to call it that, of really video tours and then online self-guided tours took off. So you think of that on top of all of the technology advancements that I'd say as an industry, we've always been slightly behind as a sector, saying how can we take advantage of that and elevate our business model. So we spent almost 6 months really dissecting what we did in the past. Everything from what does an assistant manager do? Is it necessary to do on the site? Can you do it offline? Can you do it in a centralized command center? Can you do it anywhere else? And understanding what was necessary and what wasn't, and really breaking it down. So we have a model today that we've created that we're developing and we'll institute probably by end of year, which I can't disclose totally as to what that is, and then move forward with more testing in 2022. So I think what we'll see within the next 24 months is a shift in how we operate our business through technology and also through what customers have told us. I think to be a really good business, you have to listen to your customers. And the customers are telling us, especially on the front end, I don't need to go see you, leasing consultant or Mark Taylor management team, but I want access to your buildings. I want to see what you have to offer. I want to understand what your reviews are, how well you manage your asset. I want to feel and touch the asset, but I don't necessarily need you to handhold me. I think about a used car dealership. Do I want to go and have someone walk me around and show me every car and give me a hard sales pitch? Not necessarily. You think of the success of Carvana. Carvana has exponentially grown over the last 4 years. I just had someone in my office that bought a car. They put it in the car vending machine, dropped it down, got to drive it home. Pretty cool experience. So listening to the consumer, understanding how they want us to show up for them, not just on the front end, but also, okay, from a service perspective. We just completed a resident survey of 2,000 plus residents to understand their desire for smart home technology. What do they want to see? What would they pay for? What don't they want? To really gauge and understand, what we have to prepare for going forward. So there's a lot of conversations around smart home today, and that's just one piece of it. So, listening to customers, looking at what we can do to be more efficient as a business model going forward, and understanding how we can be, I'd say, market leaders going forward in that space.
Yeah, I'm curious if, as a third-party operator, how you see the smaller, and when I say smaller, it could be 75-unit property. Before, the one person per 100 units plus the maintenance, and some management companies would just say they would have minimums because they're not able to use. They need the staff in many cases to operate. Are you seeing any opportunities that investors can look at even smaller units or smaller portfolios with technology and create some value there?
Yes, and you have to look at the fundamental shift of development. Build for rent is the prettiest girl at the dance today. In 2018, there was really less than 2% of the supply. Now it's 4%. And I don't want to say exponentially growing, but there's so much capital behind build for rent across the country now. Phoenix has really proven it out. Going back to, give a lot of credit to Next Metro. Starting in Tucson and building that platform, and there's so much focus on that space today. And the reality is, of those type of products, there's a lot of smaller products. So 50 to 150 unit deals. So you have to find a way to create economies of scale, both through technology and then just sheer size and volume. So I think that space is here to stay. The question in 2016 was, will that be sticky, or is it just kind of a niche market that was kind of a flash in the pants and then go away? It's clear it's here to stay. Specifically in Phoenix, I think it's helping to offset some of the single-family for sale supply issues, for sure. If you think about where most of those are primarily being developed, it's in the suburban locations, which were grossly underbuilt from 11 through really 2020. So the growth in both rent levels, the capital markets, the story matters, the narrative matters. People are talking about build for rent constantly. So I think it's here to stay, and I think you'll see more investment in that across the country as it broadens out. Yeah, and we're talking about that tomorrow with Steve Laterra there. Yes. Laterra Communities. So there'll be a very interesting conversation. And Tanner was talking earlier on the show around that story, that brand story. When investors are looking, and you're having these conversations with them, in many cases they're
hiring you to take care of the real estate. So in other words, the IRR, the cash flow, all the sort of deal point obvious financial metrics, what's the not so obvious that people should be looking at? You mentioned a little bit about the customer and all that, but what's the not so obvious that maybe
I mean, I think this ties to an individual investor and/or someone like Steve Latera, who has aspirations to build thousands of units in this market. I think you have to look at specifically the location of your build or investment. You know, what is your zip code? So what I mean by that is, what's your demographic? What are the jobs like? What are the schools like? These are all things that matter when you think about just where do you want to live. It translates into investment. So if you have a TSMC just down the street that's creating a $15 billion plant, you're going to have housing needs, you're going to have schooling needs, you're going to have transportation and road infrastructure needs and housing. So I think that's a big piece of it. Think about the development pipeline. Think about understanding what's available, what's being built, what's planned, really looking forward with as much data as you can. You can't predict prospective deals. You don't know if that's going to happen. Is there capital going to fall through? Is it going to get knocked down if it's a rezoning issue? All of those things matter. What's going on at the local level from a municipality standpoint? Are the city councils pro-growth or not? Is the mayor pro-growth or not? There was just a shift in Scottsdale. It's no longer a pro-growth city based on what the city council ran on and won the election and the mayor. So you have to think about what does that mean for future development and what does that mean for your investment. So I think you have to factor all of those things in to really understand if that's the right decision for you going forward. And then you think about fundamentals, which we track closely, as you know. What's the temperature of the room from an operational perspective? Phoenix has the most explosive growth from a rental perspective ever. So if you think about our market rents are 31% over rents last year. That's advertised rents. Effective rents are 18%. That's a significant increase. The highest ever before was 8.2% for our portfolio. So there's a tipping point also, but it matters in terms of what's happening today. So I have investors saying, hey, John, if I'm going to develop, my construction costs are up 10%, do you think this rent growth will continue? Will it pull back to 10%? Will it pull back to 5%? The only thing I can tell them to be true, if you go back to 1982 through today, average rent increases are 3.2% over that time period. It goes like this. So if you're conservative by nature, you say, okay, I can underwrite 3.2%. I can make my construction costs work. I'm going to build this deal based on my investors' objectives. Then do it. But if you're going to underwrite, say, I need 10% rent growth in my model for the next 5 years, I'd be concerned if I'm an investor or an individual.
Yeah. Let's dive into the asset class, too. Okay. Because I imagine that's different. You've seen a lot of different changes at the core asset. Tanner was talking about the cap rates on B properties, the values, the trends over the years. What are you seeing right now?
In a nutshell, cap rate compression. There's so much capital in this market chasing deals. People are removing, I'll say, levels of fundamentals in their zest to buy something. I'll give you a couple examples. I'd say that we were, I'll just use the last 4 years, we were typically a 4.75 to 5.25 cap rate market. That would vary based on classes, Class A, B, C. Today, in the Class A space specifically, I know there's deals transacting below a 3% cap rate. So some people say that's mind-blowing, but it's reality. It's happening, and they're justifying it through what I just said. Well, we can get X on rent growth. We can lower our exit cap rate from maybe it was a 5, now it's 4%. The cost of capital is extremely cheap. So there's a lot of ways to get around that. And you think about the arrows leading here from I say this as not it's a data point, but it's almost an additive, the in-migration aspect. You see so many folks moving here, and I'll give you some data from Google Analytics for marktaylor.com or ILS, or what we call ILS, but it's our website. Sure. You look at California specifically in 2018, California, in terms of searches on marktaylor.com, were not in the top 20. 2019, top 10. 2020 top 5. Today it's number 2.
Wow.
Phoenix, California. We have 0 assets in California. So attribute to our page 1 search.
Right.
But the reality is people are accelerating in terms of moving here, not the opposite. So I get that question all the time. Do you think more Californians are moving here today? Absolutely. They bought 20.7% of the single-family home supply in May, with cash usually.
Sure.
Right? That's common. So I think the demand from the in-migration continues. My concern would be, and I talk to the team about this all the time, what we call boomerang effect. So think about if you're let's say you're an engineer with Cisco based in San Francisco and you moved here last year during the pandemic and you signed a 12-month lease. Now headquarters is saying, hey, got to come back to the office. So does that person go back? Probably. I've had some people that stay and find a new job. But from a tried and true data perspective, we can't calculate that in our models.
There, like you said.
Jobs there, or is it here? No one really knows. But my concern is that the demand goes back, whether you considered it a job or not. So the boomerang effect is concerning. I just don't know what that number will be.
And that's in many markets.
Sure.
Not just Arizona.
Sure.
I mean, we're seeing that companies are. I almost see the trend. When one company says they're going to do something, others follow. And I mean, just the consumer brands. Even you saw that in the early workplace culture of the ping pong tables and all the sort of amenities that were being provided to everyone. Started jumping on. Oh, this is what we need to do to keep employees happy. And now that hybrid conversation is almost one of those signals that they're looking at to be competitive to find talent. They need to create those flexibilities, and that could be in a situation where maybe they take the job or be in both places. I don't know. It'll be interesting.
Well, I think it's also you think about when you talk about the single family for sale market, it's a seller's market. I think it's also an employee market. That employee can go find viable work in other markets without much effort.
Right.
So there's some flexibility advantages to being an employee today, in my opinion, especially if you have skills. Mm-hmm. If you build your skill base, you don't necessarily have to go back to San Francisco. I'm certain that you can find a plethora of jobs here that fit your criteria, and you might like Phoenix better. I've had a lot of people, friends, colleagues, guys I've worked with for years from other markets are known and saying, hey, I'm trading in my Chicago hat for a Phoenix hat, and it sticks.
And what, Game 4 is tonight?
Game 4 is tonight, yeah.
Lots
of eyes on Phoenix.
Yeah, lots of eyes on Phoenix, a lot of good trends. But I think the fundamentals as you talk, going back to the early days of Scott, you mentioned about sort of when you've been through, SNL stuff and you're bringing those values, jobs being at the core of your, and having that data is important. But that would apply to really any market, any developer. What do you look at when you go into an acquisition, or maybe an investor calls and says, we're looking at this, what do you think? What do you guys go into at the property level? So
what's interesting is today, as a developer, we don't acquire today, we just build. But from a business development standpoint, we, from a consulting basis, work with scores of developers and have since 2016 by design. So the addition of that too is existing clients and new clients coming to market, looking at deals. We underwrite every deal that's on the market and have continuous conversations with these groups as they chase deals. So it gives us a lot of perspective from Goldman Sachs through mom and pop, what they're actually looking for. And I think today the common theme is I have to place money. So if you think about that, I have to buy something, whether it's a 1031 or I'm paid to place money, I have to get money out. So when I go back to the original analogy or visual of the filter over Phoenix, that's driving price rate increases and cap rate compression without question. I don't know of anyone that, from just a pure fundamental standpoint, saying I'm going to go to Phoenix and buy a deal at a 4.75% cap rate, look at my basic fundamentals, do rent growth at 3.2%, and trust that it's going to work. You can't get a deal. So you have to play what I say the rules of engagement today. The rules are different today, and you have to modify your acquisition strategy around that. So I know guys that will never get a deal in Phoenix because they don't play the game the way it is today. Now, if it shifts back to maybe a more normal market, perhaps they can. But I'll have a group call me last week. Hey, I'm looking for an off-market deal, Class A deal. I can close all cash. Looking for like a 4.5 cap rate. And I said, well, that doesn't exist here right now. It may. So you have to play the rules or engage in the game as it is played today. That matters a lot.
Yeah, and what do you say to those conversations? How do you?
I'm very transparent by design because I don't want to waste their time or ours. Yeah. I know the groups that desire a deal and showcase it as such. Like, I'm going to go X, all in. I'm going to go above listing. Cash is king. Mm-hmm. So there's a lot of things we look at in terms of that to say, okay, this is a viable buyer. We want to work with them. And then groups that we've had long-term relationships with, we know their investment strategy, which matters a lot, how they're going to go into the deal process. Do they have relationships with the sellers? Do they understand the brokerage community? There's a lot of things around that matter. I think we speak less about the asset today, which is unfortunate. I think when you're truly looking at fundamentals, you have to understand what you're buying. What's the unit mix? What's the square footages? How's it in the competitive set from a micro perspective? Is it a good developer? Will that community stand the test of time? What's your strategy? We call the upgrade or imagination story something that's very prominent today still. So you buy a vintage 90s or 2000s deal and you say, I'm going to put, just say $20,000 of CapEx in and underwrite a $300 rent pop. That kind of has to happen today to get you the right number to get the deal so that you can make sense of it. So you see, we track every deal that transacts since 1991. There's been almost 3,000 deals transacted, 70s forward in terms of vintages, and you'll see the 90s and 2000 vintages creep above 2010 and newer occasionally because of that imagination story. You're underwriting that big value add play. So it just depends on where you're looking, what you're looking for. But I think, as we temper back and slow a bit, we'll start to get back to the fundamentals and the asset quality matters. What are you actually looking for from a real estate perspective? Yeah,
I mean, you mentioned that data. That's not data you license. That's data that you guys hold internally, right? I mean, that's
correct.
Yeah. What inspired that early on? You mentioned early,
I think early on it was about really making sure we could maximize our investment in our developments and our management.
Data wasn't a big story then.
No, not at all. Not at all. And some people say, "Oh, I'm tired of you talking about data," but I don't want to say it's a crystal ball. But you can certainly look back, and if I showed you some of our graphs specifically, you can really see a very tried and true story. When this happens, when X happens, Y will happen, and subsequently thereafter. Mm-hmm. And it really helps us, what I say, be proactive in the market. So not only operationally, but from a development perspective. I mentioned 2011, 2008. We're slowing down a bit on the development side. Will we have sites that we want to acquire? Sure. But pricing has to make sense. Fundamentals have to make sense. So that data really keeps us within our lane. I call it that way. I think if you're not seeing the world through data, it's easy to get emotional, right? Mm-hmm. So you talk about emotional buys. I see it all the time. I see it with friends, people that want to go buy a house. Mm-hmm. Well, I got to buy a house, and I'm going to pay 10%. I'm going to miss out, right? It's the FOMO effect. But if you break it down by data, remove the emotional equation, you start to say, oh, well, maybe that's not the best decision. I'm not saying you shouldn't do it, but give yourself that perspective to allow for the right decision going forward.
Anything you can share with us now, like what in terms of that? We used, the leading indicator stuff that makes some of those decisions less emotional and more logical.
I think it also is, there are a couple things. I think one, anyone that's probably Gen X or older probably has gone through marriage or family formation, having kids, what have you. You need more space. So a lot of times people are buying real estate because of that, not because of the fundamentals of real estate. I have a couple friends today having their third kid. They need a bigger house. So they're forced to go into that that market that it is today. 29 days average on the market for single family for sale. Median new housing sales almost equaling each other at about 400,000. If you believe in the market long term, that's okay. I think the folks that get in trouble both individually and from a group or larger investment tool or strategy is you buy things and you try to time the market. So I'll give you an example. If you're going to buy a deal today, but you have to get out in 3 years, put short-term financing on, you don't know what's going to happen. There could be a black swan, like the pandemic. There's lots of things that can derail your investment. But if you're in it for the long haul, if you have a long-term strategy, we know real estate will appreciate over time. Now, it's going to do some of this, potentially, but can you weather the storm? Do you have the capital reserves to get through that? And I talk to that very same, I say, hey, to my friends, do you have a 6-month reserve? Do you know what's going to happen? Do you have a 12-month reserve just for your home? We do that for multifamily assets, 6 to 12-month reserves. You never know what's going to happen, like a pandemic, eviction moratorium. Who would have thunk they could take away property rights? The CDC.
Oh my goodness.
They did, and it's still happening. So I think you have to be prepared for the black swan. You have to understand what could happen, what could go wrong, but trust the data, trust your instinct. I think if you look at Phoenix Metro today, we've been underbuilt for really since the inception of the last cycle or pre-recession. So what do we do going forward? Can you grow the supply fast enough to match household formations? I don't know. If you look at where those homes are being built, the amount of supply we can or can't create because of labor is a big issue. I mean, we haven't talked about that yet today, but qualified labor on the construction side is very difficult. For every 5 drywallers we have, we need 15. And as the supply, I think the supply chain will start to shake out, and as that improves, we still don't have the labor to support it. So we're building as slow as ever, and that's as a marketplace, not just Mark Taylor.
You mentioned reserves, some uncertainties even in like the eviction moratoriums and stuff. What are you looking at when if you're putting a deal together today? Now I know you guys aren't doing the development deals the acquisition deals, but maybe on the advisory side of third-party managers, they're going in, they're trying to acquire something. You guys would be managing out-of-state investor. What is it per unit on the reserves? What are you looking at on the sponsor reserves?
I think it just depends on their investment strategy. I think you want to be able to cover your debt and expenses for 6 months. That matters a lot. So really being thoughtful about your investment strategy to protect yourself. Too often, I think today, people get saved by real strong market conditions. You can see that with, I won't name names, but you have several lease-ups that have happened over the last 5-6 years that I would consider an F, meaning they were leased up poorly.
Market saved.
And what I mean by that is sure, you see them do 6, 7, or 8 things wrong, things that are, I don't want to say obvious to a novice, but for us, it's like, okay, this was wrong. They're gonna see headwinds here because of this, and it's pretty obvious. And now they're in month 25 of their lease up at 60% occupancy, and they get bailed out because there's so much capital chasing a deal. They'll take the risk because they want to be in Phoenix or they have to be. I think at some point that won't happen. That will shift
hurts
back.
The next deal they do.
Sure. Yeah. So I mean.
Positive track record.
Tremendous fundamentals, all of the things we talked about, all roads lead to Phoenix right now. We're bailing people out that are making bad decisions. It's covering that up. So when that goes away, when we get back to normalcy, I'm not saying we're going to go back to a recessionary period in terms of multifamily or single family for sale in Phoenix, but this feverish pitch will subside. So then you have to start to think about fundamentals long term. And people that make bad decisions will start to get caught. And
what's different about it this time, I think, than last correction, I guess? I think specifically to Phoenix, are more real estate dependent, I think, than ever before. But
so many factors. So I mentioned earlier, I think we are a pro-business state still today. The perception of Phoenix or Arizona as a whole is strong. I think 5 years ago, Texas, right? Dallas, Houston. They get a majority of large I'll say employers, movement in migration. A lot of people moved to Dallas and Houston, Austin, et cetera. I think Arizona's on par with that today. Millennials want to be in Phoenix. You can see that through various surveys, what have you. People want to be here from that perspective. So in-migration is different than it was then. If you look at the investment outside of just what we've done from a state perspective, but education-wise. So you think about, I mentioned that earlier, but education-wise, we can support those businesses, which matters. If you look at the sector breakdown, we were about 16% construction in 2008. Today, that's down to 5%. So we're adding viable sectors that help us transform and evolve as an economy. We're more diversified than ever. That matters a lot. Household formations have changed. So we've been undersupplied as a marketplace since 2011. With household formations going this way, with in-migration happening, with capital markets moving to Phoenix, all of these things are green, green, green on our charts, our graphs, green, 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 green. I've never seen anything like it. So I think that continues. And if you look at just, I'll say it this way, Phoenix today, if someone says Phoenix to you, or us, or as you have conversations across the country, oh, red hot, or that's a place you want to go. So I think a bigger piece than we even admit to ourselves is perception. It matters a lot. So I think that's a key, and all of those things underneath that are feeling that perception into reality.
Yeah, there are other markets around the country that have that similar perception as well. Let's talk about the moratorium stuff, and not to get too legislative on things, but it does apply to risk, and how do we shake through that? I mean, I know you were really involved in supporting growth in that area. Not only you have a company focused on it's important to your business, but as an industry, what are you seeing in terms of what should investors be looking at moving forward with that?
I think anytime you have a government entity such as the CDC overreach, and you could say right up to the Supreme Court, they somewhat agree with that if you read their argument from their most recent brief. But I think that's a concern for everyone because striking down evictions, we're in the business of creating homes for people, but there's certain folks that have gamed the system and continue to do so, and you have to be able to execute through that process. So I think the concern overall would be protecting property rights and landlords. We are here to create homes for people. My vision and mission statement have homes in both for that reason. It's critical that we're allowed to work through that process the right way. We're willing to work with people all the time. That's the idea. We want to keep them in their home. That's what's interesting to me in terms of the perception from certain media folks and people that are anti-landlord. We want them to be
we've never had the great story, from owners and operators. It's just Hollywood has painted a lot of that perception, about landlords, owners, property owners being well off and, that type of disconnect. But I do see brands like yours doing great things for residents, whereas, there's not many other products around the world that you can make concession for, even in a pandemic. So it's been inspiring to see some of the companies work through that. But as an investor, some of these deals have been underwritten with the expectation that certain economic vacancies in place, and that's got to look at pressure for investors, knowing like underwriting today. How do we look at that, going forward? Do you reserve for that too? I know you mentioned the debt service reserve, but you sort of look at that line item.
I think you still have to look at historical numbers, look at your bad debt tendencies, look at your trailing 12 if you're looking at an acquisition. I think all of those things matter. So, I don't know that it changes your underwriting, but you have to consider it from a risk perspective. The one thing I didn't mention as we talk about the eviction moratorium is really the landscape of other major metros. So if you think about Seattle, Portland, areas that are truly anti-landlord, not landlord friendly at all, you see investment leaving those spaces. Right? You see rent growth going down. areas where there is rent control, tried and true data showing that rent control doesn't work, right? It offsets the reality of supply demand.
Sure.
And we have to defend ourselves from that perspective. So there's a lot of things legislatively that matter. So you have to pay attention to that. I personally wouldn't go try to develop a deal in Portland today. I'm sure there are folks that will do it, but I'm confident the investment focus on that city today is lower than it was 5 years ago because of the sentiment and what's happening there.
Right, and that's the story I think the public probably needs to hear in terms of less supply never is good for the rental price.
Now, and if you look at Phoenix Metro as a whole, I think there's a perception. So think about this: if you're a city council member in Gilbert, you receive 15 emails from residents saying, we don't want an apartment next to us. They think of it as there's more crime, more traffic, lowers their housing value, which is not true, data specifically. They don't hear enough from us. We don't say, no, this is why it matters. This is why it's good for the community. This is us creating households to support the housing formations and the demand. These are good things for the community. And you look at our average household income, it's significant. So the reality of that person getting that information on a daily basis, they get bombarded by that. But you have someone that doesn't understand the actual data, the dynamics of what is actually needed from a housing formation standpoint. So we have to do better as an industry, and we're really focused on this right now in terms of messaging and getting the true data out. Not rhetoric, actual information that says, okay, this is why it matters, so rents don't do this. Because you have to have houses to support our household formation growth, in-migration, all the things we talked about. So us doing better as an industry in terms of messaging matters.
And customers are changing too. So, we talked about renter flexibilities. Access is the new ownership, being able to access the apartment community and even the amenities in the city. You mentioned earlier about the due diligence around city council and their appetite for growth, all of these things. I don't hear a lot of those conversations happening when people are looking at deals. They're looking at the typical, returns and their improvements at the asset level, things like that, but not taking into consideration these conversations. Where does an investor begin to discover that? Where do they go? Who do they talk to? What do you guys do to get close to that?
I think you have to get involved. So let's just say you're outside of Arizona. The Arizona Multi-Housing Association, been in business 50 years, is a great resource. They work with Capital Consulting, Courtney Levinas and team. They do a tremendous job of understanding the landscape of what's happening politically and then from a pro or anti-apartment standpoint. So it's very clear they have a tremendous pulse and understanding of what that means. So you might have groups saying, I want to acquire in this area because I know they're anti-growth. So maybe that compresses the cap rate. I can get this deal knowing that this vacant piece of dirt that needs to be rezoned to multifamily won't get rezoned. And I think that's part of the equation today. We've worked through a lot of the land that was zoned for multifamily. And to go through a rezoning case today is difficult at best. So those are things that they have to consider. AMA is a great resource, working with the right zoning attorneys throughout town, but really just understanding, getting involved with that community, understanding, okay, this is the mayor's perception, understanding, okay, here's the city council today, this is the landscape of what exists. I think you have to, as always, take time and research and invest personally. You can't just put an X on the map and say, oh, this looks good, let's go buy this deal.
Right.
I think like anything, the amount of time and effort you put into it, the focus and understanding, you have to go through that process. And it can't just be data, right? It's part of it. Yeah. But you have to understand the sentiment, what that particular area of town is talking about, what matters to them. Those things shift. The dynamics of development.
You've been in a few city council meetings, and I'm sure.
Absolutely.
Are there opportunities in the rezoning? You mentioned that there's some hurdles to get over, and tomorrow we'll be talking a little bit more about the economic forecasts and things like that. But in terms of rezoning, Are you seeing people getting through some of those in a victorious situation, or is it they're getting stuck?
Stuck or stopped or not even starting.
Yeah.
So that's a concern. So
not even starting because they know the,
right.
the lift.
In simple terms, we have to remove the rhetoric and the negative sentiment and emotion around what's happening and ensure that they have the right data points and the story behind it. And if we do that, I think we'll come out ahead over time. But it's going to take effort, financial support. All of these things have to happen to ensure that changes. We also have to start supporting candidates that get it. We can't just align with someone that we think they're the right candidate or they're the best of the two. We have to start to identify certain leadership to make sure that they're taking on the challenges of what we face today because of that negative sentiment and the negative storyline that continues.
Yeah, Ben commented about your conversation about Portland, 100% correct. He says definitely more units are needed in that marketplace. I know, like in any brand, we have an obligation to tell, how we're different, why we're different, who we help, how we help, and it's a lift that a lot of real estate operators haven't taken. Like I said earlier about Hollywood, sort of telling the story of what it, and also the news. It's like there's a helicopter and there's a fire or some murder or some problem around apartments. And that's the image that the world sees. And so we have an opportunity to see bringing in like Tanner, where he's talking about an investor that's not just looking at how much money can I make, but he's talking about things around, how people feel when they live there, right? The energy that they're having by being located near, downtown area or whatever is happening. And so I think that investors have an opportunity to change the story, and typically those that are writing the checks are, we're not marketers in some cases, right? They're maybe a financial firm, right? And they are taking significant risks. But when we get with brands like yours that together can really show that we're doing more in the communities than they're receiving in terms of respect of,
Sure.
And it's a lot of work and it's years of story. But we've seen comeback brands in the commercial space, not commercial real estate, but just in consumer products that, make a comeback. And even clothing, we've seen clothing come back.
Sure.
That, so there's hope, I think, in what we do. But we need leaders like yourself. That's why we pull you in. We're trying to extract what you're doing to build not only a financially strong organization, but a healthy one that's taking care of people, one that's taking care of investors and the community that you're building and operating in. And I think that's really what, when you pull back the lens, if we can inspire these capital partners, the passive investors to expect that. And you're seeing that in the stock market today too, that people are investing in companies that have a sustainable plan just in the world that, how you contribute as a corporation. Are you seeing those conversations? Probably not too much in the deals, but maybe on the development side.
Well, let me take it. I'll go from brand to people. So the first part of our vision statement is to become the most admired brand nationally. And what I mean by that is, we want the Mark Taylor brand to really spread out across the country. And I can go to conferences today, Florida to Chicago, and they'll say, oh, I've heard of Mark Taylor, luxury apartments builder, manager in Phoenix, right? That's usually what I hear. I want that to continue to grow. I know it matters here from a resident perspective aspect. So residents know Mark Taylor as luxury apartments. I ask everyone I talk to, hey, have you heard of Mark Taylor? And I usually get luxury apartments, and if I don't get that answer, I know we haven't done our job yet, right? We need to expand it more. And that matters to me because we know residents look outside of location, safety, security, and service. So there's a connection of safety and security and quality service with Mark Taylor, and I have to ensure that that meets their expectations. So when they move into a Mark Taylor community, it fits with them. And I'll give you an example. We removed ourselves from Class B assets in 2015 because there was a disconnect between what residents were expecting and what we were delivering just on the physical asset perspective. We thought we could counter it with the right service,
right.
But it wasn't the case. It was tarnishing our brand. So we went Class A only by design. And I think today, to support that, we have to ensure that our people, which is one of our core strategic initiatives and number one to me, we have to make sure that our people are focused on supporting that brand and our residents. And if they get it, right, they follow our principles, they understand brand matters, that this is what indeed residents are looking for, our people will support that. So if I have, we have a workforce of 550 today. If they're all on the same page from a vision, mission, principle standpoint, in supporting what we do well, creating the best-in-class service, that will translate into the resident experience, in my opinion, because there's a connection. They're creating a connection with their home, meaning the resident. My employee is connected with Mark Taylor, and it creates that synergy of service, and we get that 5-star experience. That matters to me. So that's our primary focus, and it has to be through people. It can't just be, let's add this technology piece or this widget. People first. And we're going to continue in perpetuity with that, year 40, 50, 60, and I think we'll be very successful in doing so as I pass this on to third-generation leadership someday. Not anytime soon, Patrick.
Not anytime soon. And you said so many things that might even lead into the answer to my next question, which is, how do you hire, like as an investor or even a syndicator operator, sometimes they will use third-party operators. It makes sense. How do you hire a management company? What would you look at?
Great question. I think, you have to look at, what is their core belief system? How successful have they been? What's their track record? What's their market knowledge? And I think as little as ever, you think about the typical RFP process. So anyone in this business knows, we got a deal here, property XYZ. We're going to do 3 RFPs to see which management company should be selected for this deal. We're really good at operations. I wouldn't say that we're the best at RFPs, meaning you're putting a lot of time-intensive work into creating this 40-page document that doesn't really showcase what you're trying to accomplish or what you're doing, actually. So what I like to tell those folks, and we'll do RFPs occasionally, go tour 10 of my assets. Don't tell me. Don't tell my leadership team, and then call me when you're done. If we meet your expectations or exceed them, we should work together, because that's the boots on the ground. That's the people-centric focus. That's where we're getting it done, and that's what matters. You can look at data. You can look at our performance. We typically do very well because of the proactive nature of the data, the right people, our backyard. But I think investors should look at, who's running the organization and what kind of people do they have there. For us, as an example, we look at 11 characteristics to ensure that we're protecting who's coming into the Mark Taylor family from an employee perspective. We want them to match or mirror similarities of our characteristics, and then get them in, onboard them correctly, and create a career path for them so that they understand this is a home, right? We say home, but it's a career for them. It's not just a job, because we want them to be part of the family long term, and that's why we've had such success with keeping employees a long time, and we'll double down on that long term.
Yeah, and I think also just the idea of the brand. Sometimes it's hard as operators to manage for multiple partners and keep that brand in place. So you guys have done a great job with that. So
I mean, we've worked with groups too that they want to be focused on their brand. So they'll come to town and say, "We're creating our brand. We want to essentially white label Mark Taylor." I think they're tying one hand behind their back in doing so, because the brand matters. So you get away from, again, fundamentals. Do I want to achieve my, let's just say, 22 leases per month in a lease up, or do I want to grow my brand?
Right.
What's more important to you? Well, if it's the brand, I get it.
Right.
But use the power of our brand to accelerate and grow your investment opportunity. It's a difference in philosophies. I understand. I'm a brand guy. Yeah. But looking at it objectively versus emotionally again.
Yeah, and it takes courage to protect that brand too. I mean, you mentioned saying no. A lot of people are trying to figure out how to get deals, say yes to things, but the reality is, in some cases, saying no. You were talking about saying no to B properties, or
I think,
certain assets.
if you're a young leader today, or starting a management company, or just trying to get that inertia going in terms of growth, right? Getting units is hard, especially, the first sales are the hardest, and it gets easier exponentially. I think what I've learned is I should have said no more often. I say no more often than I ever do say yes today. Make sure you're aligning yourself with the right clients, the right partners. Too often in the past, I would say, I need to get 300 units, or I'm trying to reach this unit count objective, and I'm going to sign on this deal.
Who knows?
Right. Sure. And then you look back and say, wow, I knew that was going to be a bad relationship before I inked the PMA, because our philosophy is different. I'm not saying that person's bad or wrong, but we have to be in sync. So I interview as much as anybody anymore. Like, I want to know what your investment objectives are. I'll give you an example. If you're someone that is unwilling to invest in the asset over a time period of your hold, let's just say your treadmill's broken, and because of cash flow sensitivity, you don't have the right reserves, you don't have a similar investment philosophy, you're going to ask me to put a sign on that treadmill and say, out of order for the next 45 days.
Right.
No. This is my resident, right? They signed up for Mark Taylor as much as your asset, and they expect a certain level of service. So identifying the right partners matters.
Yeah, it really does, and it's hard. And that goes back to even the earlier conversations we had about having the right capital in place, the right reserves in place, because the math is simple to understand. Like, when we fix things, it's good for it's good for retention and rents and growing rents and all those things. But sometimes deals are undercapitalized, and they're forced to do these things to squeeze out of operations. So, what for new investors, what are your thoughts around the timing of what's happening now? Do you wait and see? Do you get along with a mentor? Do you try and start small? Like, what? There's a lot of different conversations around funds and syndications and these types of things. What are your thoughts around it?
I think the first piece is understanding what your financial thresholds are, meaning I don't think you should go swing for the fences. Let's just say you're limited on capital, but you want to go buy let's say a 24-unit deal. That might put you over your skis right away. I'd probably start with 1 unit or a duplex, and really start to understand what that means from an operational perspective. I have countless friends who own 1 unit, and they're like, I don't know how you manage 19,000. I can't manage 1, right? And, oh, by the way, my water heater blew up yesterday, and my renter's pissed off. So, I think...
although managing 1's probably harder than...
I'd argue the other way. But nonetheless, I think you have to understand, okay, what's your ability to invest? What are your thresholds? Are you capable of... I'll say this way, riding out the storm if there is a downturn? That matters a lot, because the last thing you want to do is invest and then give your keys back to the bank in 2 years because of a black swan that you couldn't project, or you just weren't financially prepared to handle it. That matters. Absolutely mentorship. I think you should find or identify someone that has done this, so you can avoid some of the pitfalls during that process. All of those things, I think, would help a young investor in that light. That matters a lot, finding a mentor.
And does managing first does it give you that gives you the access to the owners too, and the relationships and the early indications of when people are moving on transactions, right? Or
yeah, I mean,
can that be a strategy? Or?
I think so. I think if you're an individual investor, you have to go through the process of all of those things. And I think too often, everything we talked about earlier, they think, okay, I just need to go buy a home because maybe they have some money in their pocket, but they don't think about all of those things. They don't work through the fundamentals and create a plan. So I don't think too many people drive to Yosemite without a plan. Maybe some do. They just get in the car and drive. But you have to understand, how much gas you need, how much money you need, where you're going to stay, all of these things. I just think you have to plan out your investment more so than anything else. You have to understand what that means. What are you going to do in 5 years? What are you going to do in 10 years? What's your loan structure? What's your exit strategy? Really think long-term about that, and it takes time and effort. And I know a lot of people want it now, but you have to really thoughtfully think about that strategy and take the time and effort to do so.
Yeah. So what's next for you and Mark Taylor?
Continue forward. You're 36. Like I mentioned, my goal is to get this to third generation someday. We're hyper focused on third-party management today, consulting and third-party management. The pipeline is significant for multifamily in Phoenix Metro, so that's our focus today. Working with a lot of folks, seeking assets in Phoenix, looking at developments. So the conversations are, what I can tell you, accelerating, not decelerating. More and more people are looking to Phoenix. You can say early cycle, late cycle, doesn't matter, but the perception and the interest is increasing.
Yeah, no, I imagine that. I really appreciate you coming in. I know you've got a busy schedule, coming and sharing the time with not only me, but the viewers. We're coming up at the end of our time here. Any final thoughts you want to leave our viewers with?
I think, like Tanner mentioned earlier, I think you've extracted everything I know within 50 minutes. But happy to answer any questions if there's time. I think from an investment perspective, use mentors, understand what you're getting into, be prepared for the black swan, the downturn. Looking back 30 plus years, it goes like this, and you can't predict it exactly. No one has a crystal ball. We have as much data as anybody. I don't know what's going to happen in 2023. So utilize everything collect as much data as possible, and make a thoughtful decision based on what you need, what your objectives are individually as an investor, and move forward. You're going to make some mistakes, and that's okay. We talk about mistakes and as just being, opportunities to learn, and that's experience. So don't not do it, though. Meaning you got to put yourself out there.
Be in the game.
Be in the game.
Rule number one: be in the game. Can you ever get to the point where there's like too much data and you can't decide, or you're not in the game because there's?
Yeah, I mean, I think there's lots of groups that kill themselves with data, but the most difficult part, and there's very few people that can do it, meaning take all of that data and then translate it into what does it actually mean, and then utilize that to make a decision. We have very few people that I know that can do that well. And in doing so, you also have to translate that into something that's executable at the site level with your leadership team. All this means this: simplify it, communicate it clearly, be transparent about it, and then move forward. So I think there can be paralysis or an overwhelming amount of data that just messes with folks. They don't know what to do, and they sit back and they're not in the game. And they look back, damn it, I should have bought that deal 6 months ago. So you have to be able to understand what that means, distill it, and execute.
Right. And when you're building software today, it's never finished.
Never finished.
It's just constant feedback loop. Get it in the hands of the customer. Let them tell you. Make an improvement. Go to market.
Sure. I mean, today we recently built our AI tool called Hobbs. So he's been in action for, I think, 6 or 7 months. I like Hobbs. He's a good guy. Never been mean to me as an AI friend.
Call in sick?
never calls in sick. But the data we're collecting, the amount of appointments we're scheduling through him, it's truly another learning experience that I didn't think I'd probably see in my lifetime. And it's exciting, and I think you're going to see more of that.
Yeah, it'll be fun to watch. And we'll be watching what you're up to. We'll make it easy for people to reach out and get in touch with you. Again, appreciate you coming in.
Yeah.
It's always a pleasure. You're always welcome back. I know we'll always reach out and tap your resources on what's happening in multifamily. So appreciate you coming in. Thank you.
Thanks for having me.
All right.
Appreciate it.
See you next time.